When people first enter financial markets, they often believe the biggest challenge is learning strategies. They believe they need better indicators. They believe they need a better entry signal. They believe they need a better technical system. But after spending some time in the market, traders slowly discover something much deeper. The biggest challenge in trading is not the strategy. The biggest challenge is psychology. More specifically, the relationship between risk and fear. Many traders confuse these two concepts. They think risk and fear are the same thing, but they are not. Risk is a calculated part of trading. Fear is an emotional reaction. Understanding the difference between risk and uncontrolled fear can completely change the way a trader behaves in the market. In this video, I want to explain something very important for every trader: the difference between risk and uncontrolled fear. Because if you misunderstand this difference, you will constantly struggle with hesitation, emotional decisions, and inconsistent trading. But if you understand this difference clearly, you can develop a calm, disciplined mindset even during uncertain markets. If you stay with me until the end of this video, you will understand how professional traders think about risk, why uncontrolled fear appears in the mind of traders, and how you can train yourself to manage risk without allowing fear to control your decisions. And if you want to continue developing a strong trading mindset, consider subscribing to Bull Mindset. This channel focuses on trading psychology, emotional discipline, and the mental habits that help traders remain consistent in financial markets. Now let us begin with the first concept: risk. Risk is a natural part of trading. Every trade involves uncertainty. No strategy guarantees a win every time. Even the best trading systems experience losing trades. Because of this uncertainty, risk cannot be eliminated, but risk can be managed. Professional traders understand this. Before entering any trade, they define their risk. They decide how much capital they are willing to lose if the trade does not work. They determine their stop-loss level. They calculate position size. They create a clear plan before taking action. When risk is defined in advance, the trader remains calm, because the worst possible outcome has already been accepted. Now let us talk about fear. Fear is not the same as risk. Fear is an emotional reaction that appears when the mind perceives danger. In trading, fear often appears when traders feel uncertain about what will happen next. Fear can appear when a trade moves against the trader. Fear can appear when markets become volatile. Fear can appear when traders experience several losses in a row. But here is something very important to understand. Fear becomes dangerous when it is uncontrolled. Controlled awareness of risk is healthy. Uncontrolled fear is destructive. When fear takes control of the mind, traders stop following their strategy. They begin reacting emotionally. They exit trades too early. They hesitate to enter valid setups. They reduce position sizes randomly, or sometimes they avoid trading completely. This behavior destroys consistency. Now let us explore why uncontrolled fear appears. One reason is uncertainty. The human brain prefers certainty. It prefers predictable outcomes. But financial markets do not offer certainty. They offer probabilities. When traders expect certainty but experience uncertainty, fear increases. Another reason fear appears is lack of preparation. If traders enter trades without defining risk clearly, the mind becomes uncomfortable. The trader keeps asking questions. What if the market drops? What if this trade fails? What if I lose too much money? These thoughts create anxiety. But when risk is defined in advance, these questions disappear. Professional traders remove uncertainty by defining risk before the trade begins. Now let us talk about something deeper: loss aversion. Human psychology naturally dislikes losses. Losing money feels emotionally painful. Sometimes even small losses can create strong emotional reactions. This emotional response can amplify fear. Traders begin avoiding situations where loss is possible. But trading always involves the possibility of loss. Trying to eliminate loss completely is impossible. Professional traders accept this reality. They understand that losing trades are part of the process. Because of this acceptance, they do not fear every small price movement. Now let us move into real trading examples. Imagine a trader entering a trade without defining risk. They simply believe the market will move in their favor. When price begins moving against them, fear appears immediately. The trader becomes anxious. They begin checking the chart repeatedly. They may close the trade early. Later, the market may recover, but the emotional decision has already damaged consistency. Now, imagine another trader. Before entering the trade, they calculate their risk. They know exactly how much they can lose. They place a stop loss. They accept the potential loss. Now, when the market moves slightly against them, they remain calm. They understand that this movement is part of normal volatility. This trader focuses on execution rather than emotional reaction. The difference between these two traders is not intelligence. It is risk awareness. Now, let us explore another situation. A trader experiences 3 losing trades in a row. The next time a valid setup appears, fear begins whispering in the mind. The trader thinks the next trade will also lose. They hesitate. They skip the trade, but later that trade becomes profitable. This situation happens often because uncontrolled fear can create hesitation. Professional traders handle this differently. They do not evaluate their strategy based on a small number of trades. They think in terms of probability over many trades. This long-term perspective reduces fear. Now let us talk about mental frameworks that help traders separate risk from fear. The first framework is clarity. Before entering any trade, ask yourself one question. What is the exact amount I am willing to lose? When this number is defined clearly, fear loses power. The second framework is acceptance. Accept that losing trades are part of trading. They are not personal failures. They are statistical outcomes. This acceptance reduces emotional resistance. The third framework is consistency. Professional traders follow the same risk management rules for every trade. They do not increase risk impulsively. They do not reduce risk emotionally. Consistency builds confidence. Now let us talk about practical exercises that help traders manage fear. One useful exercise is the pause technique. When fear appears, pause before acting. Take a breath. Ask yourself whether the decision you are about to make is part of your strategy. If the answer is no, wait. This pause can prevent emotional decisions. Another helpful exercise is visualization. Before trading sessions begin, imagine situations where the market moves against you. Imagine accepting the loss calmly. This mental rehearsal prepares the mind for uncertainty. Another exercise is journaling. After each trading session, write down emotional reactions. What caused fear? What thoughts appeared? Over time, this awareness helps traders identify emotional patterns. If this video is helping you understand the difference between risk and fear, consider subscribing to Bull Mindset, because developing emotional discipline is one of the most valuable skills in trading. Now let us talk about something very important: confidence. Confidence does not come from winning every trade. Confidence comes from trusting your process. Professional traders trust their risk management system. They trust their strategy. They trust their ability to follow rules. This trust allows them to remain calm even when trades lose. Now let us move toward the final message. Risk is necessary. Fear is optional. Risk is a calculated part of trading. Fear is an emotional reaction. When traders learn to manage risk properly, fear becomes smaller. When fear becomes smaller, discipline becomes stronger. And when discipline becomes stronger, consistency becomes possible. Let me leave you with one final thought. Successful trading is not about avoiding risk. It is about understanding risk. It is about accepting uncertainty. It is about controlling emotions. The strongest traders are not fearless. They simply understand risk better than their fear. They accept uncertainty calmly. They follow their strategy consistently, and they allow probability to work over time. Stay disciplined, stay patient, and remember that the greatest advantage in trading is emotional control. If you want to continue building that advantage, subscribe to Bull Mindset. I will see you in the next video.